Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young, and today is March 27th, 2025, and we're going to talk about the business cycle. Specifically, we're talking about the move in commodities, and even more specific, copper. Yesterday, in the main room on Wednesday the 26th, in the main room of TheoTrade, I talked about the idea of rotation and the fact that copper has a propensity to move higher even after we've already seen weakness in the economy and contraction and equities falling. Today I want to go into a little bit more detail on what we saw today in copper prices and what our opportunity may be as it associates with this standard business cycle. And we'll look for some opportunities in both bullish and bearish setups. So the first thing I want you to notice in the standard business cycle, it says normally 4 years. That's just such a random adjusted 4 years. It could be 5, it could be 10, it could be 12, and there's just generally a ebb and flow. There's large cycles and small cycles, but this overall cycle can be a massive cycle in true recession in 4 years. It could take 8 years, it could take 12 years, as we've seen. And what we're looking at is we're looking at this. Stock prices started falling early this year, and so we saw a movement into the defensive sectors and consumer staples. Commodity prices arguably fell today. Copper peaked out, like I talked about in the main room yesterday, but copper peaked out yesterday and sold off today. Now the question is, where stock prices are falling and commodity prices are now falling, at least in copper today, a significant sell-off of over 2%, are we seeing us move into this area even deeper? Are we seeing this move as an opportunity? And if that's the case, I want to be looking at the defensive sectors, consumer staples, and utilities. And utilities have had a positive day today so far, but these are the areas that we should be looking at. This can be out further. We could be looking out into utilities and financials and consumer cyclicals out a year to 2 years. So it's whether we're right here in the middle of this or not. If stock prices are falling and commodity prices are falling, we're looking for GDP to decrease. And that's going to be the early contraction. Late contraction is when property values fall. We see true signs of recession. So we're talking about at least 6 months after this, because we need 2 negative GDP quarters. And we're going to be watching for bond prices to start turning higher and higher and higher as a defensive play. Remember, the market is going to lag in this as far as in the big picture move in real estate and bonds and inflation. So we haven't seen inflation fall yet, not significantly. We've seen it slowed, but it's still climbing. So we're not in this last segment, we're here. And so if we're there, we want to be looking at this defensive sector, consumer staples primarily. Now, if we're looking at all these, one of the other things we want to take into consideration, if we are betting on consumer staples and utilities right now, and we could throw healthcare in there, what we want to know is, what should we be selling? What should we be getting out of? And if we assume this was a circle instead of a semicircle, what we would normally do is look at the opposite side of the circle. We'd be looking at the extreme other side to find where we're going to be looking at those opportunities. So that means we would be going over here. There's 11 sectors. I know we're calling defensive sectors. I'd put healthcare there. And technology and communications we could lump together through here, and services is not considered a sector as far as trading sectors. So we have 11 sectors here. We'd add technology with communications as 2 separate ones. We'd drop services, and I'd replace healthcare in defensive sectors. So what we're going to do is we're just going to go forward half the number of sectors, which means 5 or 6. So if we go from, we're somewhere in between here, consumer staples and utilities, where we're watching for GDP to decrease, we'd be 1, 2, 3, 4, 5. So somewhere between services and capital goods. I would say really technology, communications, and capital goods leading into basic materials bearish as well. So as we're watching this, and capital goods, we'd be listing this into industrials because transportation and capital goods are going to be in that area. But we're going to be looking at bearish materials, bearish capital goods, bearish industrials, while we're bullish consumer staples and utilities. And here's that chart of copper climbing up, spiking, and then collapsing. It's not just down 2% today. We're not simply seeing a correction of 2% in copper. What we're seeing is that copper made a new high after recovering from 4 to 5.40. Just in that little time frame, going from $4 to 5.40. First, copper gained 34%. And this is very similar to what we saw in 2008, as I addressed yesterday. And then we saw equities pull back while copper continued to climb. Then copper fell aggressively, confirming that there's more downside, and seeing it push roughly at the same time to bottom out where copper and equities bottomed out. And from yesterday's high, just from yesterday's high, copper has already given back 5.5% off of that high. So this is the significant sign that we're seeing in that copper is doing what we talked about, and we're going to expect to see more of the same. If we're going to be bearish, we're going to start looking for bearishness in things like basic materials and industrials. If we see this through here, this is a consolidation. I would call this a nearly perfectly symmetrical triangle. And the triangle's size here is 88 to 84. That's 5%. Not a huge move, but inside basic materials, inside the stocks here, we could find some opportunities that are going to be bigger and better to the downside. Industrials are in a downtrend through here. We saw lower highs, lower lows, lower highs, lower lows. We bounced up. If we can break through this 20-day moving average, this will likely be a continuation lower at least to 128, but I'm looking for industrials to get all the way back into this 126, 124 area. I'm not saying we're going for the low yet, but I am saying we're going to get back into this noise where we had April to August. Not there's a ton of cyclical behavior, but that would be where we're looking at over the next 2 months. And so if we can drop down to 125, 124, even down to 122, now we're talking about a 10% drop in industrials on the ETF. And there's going to be stocks inside of industrials that are going to even give us more opportunity to the downside. And that might be found inside of transportation, the IYT transportation ETF. If we can get back down to these lows, that's about an 8% drop. And I am looking for Union Pacific to fall, similar to what CSX has done, which this candle today is a pretty broad candle engulfing the previous one. This would be a breakout for me. I like Union Pacific bearish back down to these lows about 223 and maybe further. That's about a 5% move in Union Pacific, and I'm looking for it to replicate some of the ground transportation we've seen in CSX, which means a breakout, and we could see a 10% drop in Union Pacific. Going to the bullish side, XLP, consumer staples, pulled back right back to support. We've bounced. Now, this could turn into a really weird looking head and shoulders pattern. We could see considerable drop from 84 down to 79. And that's about a 5-point move. So we'd be talking about, let's call it 6% below the low, or about 7% from the current price, if it does sell off. But I'm seeing this as a pretty solid recovery. And all we need is XLP to get through the highs about 80.72. Consumer staples, I wouldn't just go with consumer staples broadly. I would be looking specifically inside of consumer staples and going back to the Costco's, the Kroger's, the Walmart's, the Procter Gamble's, and looking for opportunities inside of there. I would also consider looking into things like Altria on this breakout and seeing this as a pretty significant bull flag, where we go from the low of 52 to 59. We're talking about a 15% move, and I would argue that yesterday or today is that potential breakout. And that's even after adjusting for the dividend. So Altria is looking pretty promising, and the breakout through there. We could look again for PG to mirror what we saw in consumer staples, but I need it to get a little bit higher there. As you know, my favorite is Costco, and Costco's breakout through here. I really just need a little bit higher, maybe a close here or a trade above 945. So a close near 941 or a trade above 945, and I would be looking at Costco to return all the way up to 1,050. The last one, which we're on the cusp, like I showed you, we're about to cross over into utilities on that business cycle. After we see consumer staples continue back higher, if we see utilities rotate in, which is where we're at, then I'm looking for some significant gains in utilities. And that means we're not just looking at this as a consolidation, we're looking at this consolidation to potentially break out this full distance, which is about 80 to 75. We'll just call it $5. Again, it's about a 6% on the breakout, which is about it's about a 10% from the current price. I don't need to wait for utilities to break out. I don't need to have that diversification off of utilities. I'm willing to look into these individual stocks and say there's a lot of opportunity with low risk on things like NextEra with today's bounce. Even if we just return up here, we're talking about nearly a 10% move, but I could see that we'd get all the way back up to 79 or 80 in stocks like NextEra. Southern looks like it's broken out of its pullback with the lower highs, lower highs, lower highs, lower highs. Yesterday was a good breakout. Today is a good follow through. And we might be looking at this moving the nearly $10, and we could be looking at $99 as a target for Southern. And we took EXC in our deep currents portfolio and participated in this move, but we did it as a short put, so we were already near max gain on this short put as well. But remember, any of these that fill, any of these that you pick up as a stock, or any of these you pick up as a short put being assigned the stock, these are usually about anywhere from 3 to 5% dividend in these utility sectors. And I'm liking many stocks in the utility sector as a place to hold and look for that seeking of premium or return. And the risk-free premium is usually accounted for against the bond market. We say, well, the bond market is paying out 5%, therefore we're going to call that risk-free premium. And utilities are usually pretty close to a similar risk-free premium, but can gain while you're getting paid that premium. And so it's a matter of timing, it's a matter of rotation, and everything we're seeing in this business cycle is lining up to favor this next move into continue with consumer staples, into utilities. Don't get ready for financials yet. Let it breathe out a little bit more. But right now we're in this little area right through here. Watch for real estate to fall before we start looking for financials. But GDP needs to decrease. We're here in consumer staples, we're here in utilities, and we're going against industrials, capital goods, and basic materials over on this side, and technology. But those are the ones I'm watching. These are where we're at, and it's almost lined up perfectly as far as a normal traditional business cycle where we finally stepped into a calculable, plannable opportunity based off of economics and business cycles. That's going to do it for me today. Thanks for watching, and join me again next week.